Welcome to the deep dive. Okay, let's unpack this. Imagine a company that influences where you stay when you travel, but you probably don't even realize they're behind thousands of hotel doors. We're talking about a real powerhouse operating, behind the scenes. A name you definitely know, but whose core business model might just surprise you. Today, we're embarking on a deep dive into Choice Hotels International Inc., a colossal lodging franchisor that's strategically expanding far beyond its traditional roots in accommodations. Our mission for this deep dive is to truly understand how Choice Hotels, this giant in the hospitality world, generates its substantial revenue, what makes its unique asset-light approach so successful, the critical challenges it navigates in today's constantly shifting travel landscape, and precisely where it's strategically heading in the years to come. We've received a fascinating stack of investment research that shines a bright spotlight on this innovative business model, giving us a privileged peek behind the curtain. And to help us decipher this intricate world of hospitality, finance, and strategy, we have our expert guide with us today.
Thanks. Yeah, what's truly fascinating here, if you really dig into the details, is that we're looking at a company actively engaged in a deep effort to redefine its identity. It's strategically moving beyond its historical strongholds, into new, more lucrative market territories. We'll explore whether the market, in its current valuation, really gets the full scope and potential of this ongoing transformation yet. It's a big question.
Definitely. So, whether you're curious about the inner workings of massive global brands or the intricate dynamics of how the travel industry is evolving, or maybe just what ingredients make a business model remarkably resilient through economic cycles, this deep dive is absolutely packed with those aha moments. You might think you know the hotel business, but I promise you, you're about to discover a whole new, often hidden side of this incredibly dynamic industry today. So let's peel back the layers. Let's start with the absolute fundamentals. What exactly is Choice Hotels at its core, and what does its global footprint look like?
Okay, so Chase Hotels, ticker CHH on the NYSE, it stands as one of the world's largest lodging franchisors. And to really grasp their scale, just think about this. As of mid-2025, they managed a massive global portfolio. We're talking over 7,500 hotels.
Wow, 7,500.
Yeah, and that translates to nearly 650,000 rooms, strategically spread across 46 countries and territories around the globe. But the single most important word here, the one that defines their entire operational strategy, their whole financial model, is franchisor.
Yeah.
They're a franchisor. They are fundamentally not in the business of owning the real estate, the physical buildings themselves. And that's a critical distinction. It really underpins everything they do.
So, just to be crystal clear, they don't own the actual hotels.
Right.
That sounds like a massive game changer in an industry that's usually so capital intensive. How does that asset light model actually work day to day? Why is it so effective?
It is the absolute heart of their strategy. And it's precisely what gives them such a distinct competitive edge, I think. They intentionally choose not to bear the huge capital expenditures. Think of the enormous costs involved in buying property, building new hotels, or even just big renovations.
Right, billions potentially.
Exactly. Nor do they shoulder the day-to-day operational risks that come with direct hotel ownership. It's just not their business. Instead, their model revolves around licensing their well-known brands like Comfort Inn, Quality Inn, Cambria, and providing a whole suite of critical services to independent hotel owners. Those owners are the franchisees. And in 2022, get this, 97% of their total revenue streamed directly from these franchise fees and royalties.
97%.
Yeah. So this asset-light model, it acts like an incredibly powerful engine. It consistently generates predictable free cash flow and delivers pretty robust returns on investment. This structure gives them a level of financial agility, to navigate economic ups and downs much more smoothly than traditional hotel owners who are tied down by the physical assets.
It really highlights leveraging the brand and the system, not the actual bricks and mortar.
That's it. Exactly.
Okay, that distinction really clarifies their approach. But let's put ourselves in the shoes of an independent hotel owner for a second. Why would they choose to become a Choice Hotels franchisee? What specific benefits do they get from this relationship, especially when they're giving up a chunk of their revenue?
Yeah, it's a fair question.
Yeah.
But for an individual hotel owner, it presents an extremely attractive value proposition, especially in today's crowded market. I mean, think about it. They gain immediate access to powerful, established brand recognition, something that an independent hotel, no matter how good it is, just can't replicate on its own.
Like seeing that Comfort Inn sign on the highway, you know what you're getting.
Exactly, that trust and familiarity. And beyond the brand, they plug into a sophisticated global marketing and distribution engine. That's absolutely crucial for driving bookings, keeping occupancy up. Choice Hotels also gives them their proprietary Choice EDGE reservation system. That's a cutting-edge, cloud-based tech platform designed for optimal booking performance.
Okay.
And of course, a huge draw is the loyalty program. The Choice Privileges program has like 65 million members. That's a massive pool of repeat customers.
65 million, wow.
Yeah. So all these pieces together, they enable independent operators to generate superior revenue, often significantly higher than if they tried to go it completely alone. So you can see why the financial health, the overall satisfaction of these franchisees isn't just important, it's a critical leading indicator for Choice Hotels' future growth and financial performance. Their success is intertwined.
Okay, that makes a lot of sense. So if they're not owning the hotels, but they're providing all these valuable services and helping drive revenue for their partners, where does the money actually flow from for Choice Hotels itself? What are their main revenue streams?
Right. It's almost entirely a fee-based model. High margin, recurring revenue, which is the kind of model many industries dream of because it offers such stability. The lion's share, the real engine, comes from royalty fees. This is basically a percentage of franchisees' gross room revenues. So to give you a concrete example, their domestic effective royalty rate, that's a key metric they track closely. It was 5.11% in Q1 2025. And it even ticked up slightly to 5.12% in Q2 2025.
Stable, even growing a bit.
Exactly. And that stability, even that slight increase, that tells you a couple of important things. First, it suggests Choice has strong pricing power. Second, it hints at a favorable mix shift happening in their portfolio. They're moving towards those higher fee, more lucrative brands, which we can definitely get into more detail on.
Okay, so royalties are number one. What else?
Right. Beyond royalties, they collect initial franchise and relicensing fees. These are essentially one-time payments. An owner pays when they first join the Choice system or when they renew their franchise agreement, which typically happens every, say, 10 to 20 years.
Gotcha. One-off payments.
Yep. Then there are marketing and reservation system fees. Now, these are collected from franchisees too, but they're largely passed through. The money goes into a system-wide fund that pays for national advertising campaigns, digital marketing, and maintaining that sophisticated reservation tech we talked about, Choice EGGE.
So not directly profit for Choice, but essential for the whole system's health.
Exactly. It supports the brand's visibility and tech edge, ultimately benefiting everyone. And then there's another stream, maybe less obvious, but really valuable, procurement services.
Procurement. How does that work?
Think about it. A single hotel owner trying to buy, I don't know, thousands of towels or dozens of TVs or even just get better rates on cleaning supplies. It's tough to get leverage. Choice steps in here. They leverage the immense collective buying power of their entire 7,500 hotel system.
Economies of scale.
Precisely. This allows them to negotiate really deep discounts on everything: furniture, fixtures for new builds, everyday operating supplies like coffee, toiletries, you name it. It's a powerful win-win. The franchisees save significant money on their operating costs, boosting their own bottom line. And Choice earns a small but high-margin fee for setting up these deals.
That's clever. It's another reason for franchisees to stick with them.
Exactly. It's not just a minor revenue stream. It adds another layer of sticky value that makes it really attractive and financially sensible for an independent owner to stay within the Choice system.
So Choice Hotels isn't just one single brand, clearly. They manage this, as you said, impressive array, almost a kaleidoscope of options. How do they strategically position these 22 brands across the market? How do they avoid, stepping on their own toes?
Yeah, that's a great question. Their portfolio is incredibly diverse, and they're quite meticulous about it. They manage 22 distinct brands, and these are strategically positioned across 6 different market segments. It spans everything from budget-friendly economy options like Econo Lodge or Roadway Inn, all the way up to upper upscale properties like Cambria or the Ascend Collection.
Okay, quite a range.
A huge range. And this broad offering is critical because it lets them meet an astonishing variety of traveler needs and budgets, from the most cost-conscious road tripper to a more discerning business traveler. And just as importantly, it provides developers the people actually building or converting hotels with a diverse range of options. Different brands suit different market dynamics, different investment levels. This helps avoid direct internal competition by targeting different price points and customer expectations. Now, historically, their foundation, the undisputed backbone of their domestic presence, was firmly in those economy and mid-scale segments.
Right, the ones we see everywhere.
Exactly. Brands that have become synonymous with road trips and value. Think Comfort, Quality Inn, Sleep Inn, Econo Lodge, Roadway Inn. These really formed the historical core of their business. They built their reputation on reliability and accessibility for budget-conscious travelers.
But you keep saying historically, which definitely implies a shift is happening. So where are they focusing their growth efforts now? What's the strategy behind this evolution?
This is where it gets really interesting, and frankly, it's a pivotal turning point for the company. Choice Hotels is undergoing a very deliberate, very calculated, and quite significant strategic transformation. They are actively and aggressively shifting their focus towards what their management often calls revenue-intense segments, specifically upscale and extended stay properties.
Revenue intense. Okay.
Yeah, and this isn't just about simple diversification, like, like adding a few new flags. It's a profound, calculated move. It's designed to fundamentally increase the average royalty dollars they generate per hotel unit in their system.
How does that work exactly?
The logic is pretty straightforward, actually. Hotels in the upscale segment, think Cambria, Radisson, and the extended stay brands like WoodSpring Suites or Everhome Suites, they command significantly higher average daily rates, ADRs.
Right, they charge more per night.
Exactly. And since Choice's royalties are a percentage of that room revenue, a higher ADR directly translates into higher, more profitable fee income for Choice itself. So by systematically growing these higher ADR segments faster than their traditional economy and mid-scale brands, they are intentionally engineering a structural mix shift within their portfolio.
Ah, okay. Changing the average.
Precisely. The goal is to elevate their system-wide effective royalty rate and ultimately dramatically boost their overall long-term profitability and revenue stability. It's a smart strategic move.
So which specific brands are really leading this charge into these higher value, more profitable segments? Can you give us some concrete examples?
Absolutely. In the upscale segment, we're talking about brands like Cambria Hotels. These are typically modern, often urban-centric properties. Then there's the Ascend Hotel Collection. Ascend is particularly clever, I think. It's a soft brand. It allows unique, independent hotels to affiliate with Choice, so they get access to the reservation system, the loyalty program.
But they keep their own name and style.
Exactly. They retain their distinctive identity and local charm. It's a great way to bring interesting properties into the system. And then, of course, there are the Radisson and Radisson RED brands. The 2022 acquisition of Radisson Hotel Group Americas was absolutely pivotal, a game changer. It gave Choice immediate scale and brand recognition in that competitive upscale space.
Okay, and what about extended stay?
Right. For extended stay, you've got leading brands like WoodSpring Suites, Everhome Suites, that's their newer purpose-built prototype, very modern. Then there's Mainstay Suites and Suburban Studios. All of these offer apartment-style accommodations for guests needing longer stays. Think business travelers on long projects, construction crews, relocating families, traveling nurses. A really diverse group.
So if I'm connecting the dots here, this isn't just about adding flags. It's a fundamental re-engineering of their revenue profile to boost profitability. But what are the biggest challenges they face in getting this done? Like convincing existing economy franchisees to maybe upgrade or attracting the right developers for these pricier segments?
That's a really perceptive question, and it absolutely highlights a core challenge in this transformation. Well, the overall strategy clearly benefits Choice Hotels by increasing those royalty dollars, convincing a developer or maybe an existing economy franchisee to invest in a much more capital-intensive upscale or extended stay property. Well, that requires a different kind of pitch.
Yeah, it's a bigger ask.
It is. The biggest hurdles often revolve around access to capital for franchisees, especially in a high-interest rate environment like we've seen recently. Developing a brand new Everhome Suites or a Cambria hotel costs significantly more than, say, renovating an existing Econo Lodge.
Sure. Much bigger investment up front.
Right. So Choice addresses this in a couple of ways. One key tool is offering what the industry calls key money. These are essentially upfront financial incentives, sometimes structured as loans or grants, designed specifically to accelerate development in these strategic segments.
Ah, okay. Sweetening the deal.
Exactly. They also heavily emphasize the benefits for the developer, the higher average daily rates these properties command, the potentially more stable, often corporate-based demand you get from extended stay. All of this can lead to superior long-term returns for the developers, even with a higher initial investment. It's really about managing different stakeholders with different risk appetites and return expectations. It's a delicate balance.
Okay, that makes sense. Now, while many of us, maybe particularly here in the U.S., think of Choice Hotels as very American, They certainly have a significant global presence too, right? What's their international strategy look like, and how important is that piece to their overall growth picture?
You're absolutely right. While they are predominantly U.S.-centric, if you just count the number of rooms, international expansion is undeniably a critical and I'd say accelerating growth pillar for them. As of June 2025, their portfolio included, over 500,000 domestic rooms, but also a substantial footprint of nearly 144,000 international rooms. That's not insignificant.
No, definitely not.
And their approach to global growth is actually remarkably flexible, very pragmatic. They often choose direct franchising in mature, developed markets, places like Western Europe or Australia. This gives them more direct control over brand standards, marketing, the whole growth trajectory. But in contrast, they often leverage master franchise agreements in other regions, particularly developing markets. They partner with local experts who possess that invaluable on-the-ground market knowledge and existing infrastructure. It's a smart way to scale faster in complex markets.
And they just made a really significant move in Canada recently, didn't they? That sounded like more than just a routine deal.
Yes, it was indeed a very strategic play and quite telling about their priorities. In July 2025, Choice Hotels acquired the remaining 50% stake in their Canadian master franchisee, Choice Hotels Canada. They paid about $112 million for it.
So they own it outright now.
They do. And this move is strategically profound. It fundamentally converts their Canadian operations from that lower margin master franchise relationship where they just collected a fee from the master franchise to a much higher margin direct franchising model.
Cutting out the middleman, essentially.
Pretty much. And what this means for Choice is gaining full control over the development pipeline in Canada, dictating the marketing strategies, ensuring strict adherence to brand standards across the country. Crucially, this acquisition also immediately allows them to introduce all 22 of their brands into the Canadian market. That's a huge leap from the previous 8 they had there under the old agreement.
Wow, big expansion potential.
Exactly. And management has publicly projected that this consolidation alone is expected to generate an additional $18 million in incremental adjusted EBITDA just in 2025. So you see the immediate financial impact.
That's significant. So could this Canada acquisition serve as a kind of template for how they approach future international growth? A way to get more direct control and a bigger slice of the revenue in key developed markets?
I think it definitely signals that. It very clearly shows a strategic preference to, let's say, in-source operations in developed, high-potential markets where they see significant upside.
Yep.
This allows them to capture more of the value chain, absolutely, and to aggressively drive unit growth, tailoring their strategy directly to local conditions without needing a master franchisee's approval.
Right.
But this focused, hands-on approach is carefully balanced with smart strategic partnerships elsewhere. They're not trying to do everything directly everywhere.
Right. Makes sense.
For instance, they recently renewed a big 20-year master franchise deal in Brazil, which is a massive, still developing market. They also have significant new agreements in places like France, Scandinavia, and notably China, including a deal to potentially develop up to 10,000 rooms there.
10,000 rooms in China.
Yeah, that shows the scale of ambition. So it's really a nuanced, multifaceted international expansion strategy. Direct control where it makes sense, partnerships where local expertise is key.
Okay, so we've really dug into their unique business model and their clear strategic direction. Now, let's pivot a bit and look outwards. Let's consider the broader macroeconomic picture. How is the overall hotel industry doing right now? Is it still riding that post-pandemic wave, or are things getting more complicated?
Yeah, the U.S. lodging industry, without a doubt, is navigating a period of, let's call it normalization, after that incredibly strong rebound we saw right after the pandemic restrictions eased. For 2025, the current projections are pointing towards modest RevPR growth revenue per available room, maybe around 2.58%, bringing the average RevPR to about $102.78.
Okay, so growth, but slower growth.
Slower growth, exactly. And that growth is expected to be primarily driven by increases in the average daily rate. The ADR, basically, room prices going up slightly, maybe around 1.99%. Occupancy rates, while stable, are expected to hold pretty steady at roughly 63.38%. But importantly, that's still slightly below the pre-pandemic levels we saw back in 2019.
Still haven't quite caught up on occupancy.
Not quite. So to answer your question directly,
Right.
no, it's definitely not a booming market anymore. It's more characterized by continued, yes, but more modest growth happening amidst increasing economic uncertainties.
But it sounds like it's definitely not smooth sailing for the individual hotel owners, the franchisees themselves, who Choice ultimately relies on. What are the specific headwinds, the financial pressures these owners are facing right now.
You're absolutely correct to focus on that, and this is a critical point of potential, let's say, indirect risk for choice hotels. The operating environment for individual hotel owners is becoming increasingly challenging. They're dealing with a confluence of significant operational pressures, persistent inflation across lots of cost categories, combined with those elevated interest rates we've seen, and ongoing labor shortages. It's creating a very tight operating environment.
Labor shortages are still a thing.
It's still a major thing. The AHLA's 2025 report, that's the American Hotel and Lodging Association, it vividly highlights that property-level operating costs are rising faster than revenues. We're talking about maintenance, utilities, insurance, sales costs, IT expenses, all up nearly 5% in 2024. That relentless cost creep is seriously compressing profit margins for franchisees. And on the labor front, yeah, an alarming 65% of hoteliers are reporting persistent staffing shortages. That inevitably drives up wage costs as they compete for scarce talent.
Wow, 65%. That's huge.
It is. And then concurrently, that sharp and sustained rise in interest rates since 2022 has significantly jacked up the cost of capital for hotel owners. So financing new construction projects or future acquisitions is considerably more expensive now. It can also lead owners to delay or maybe scale back necessary property renovations.
Which could hurt the brand image eventually.
Absolutely. So this formidable squeeze on franchise profitability coming from both rising costs and higher financing expenses, it really represents the most significant indirect risk for choice hotels. Because widespread financial distress among their franchisees could potentially lead to deteriorating brand standards, maybe an increase in hotels leaving the system, what we call deflags, and, critically, a slowdown in that development pipeline that's so fundamental for Choice's future unit growth.
And we saw a tangible sign of this softening demand recently, didn't we? The Q2 2025 results showed RevPAR actually declining. That seems counterintuitive after all the talk of travel rebound.
Yes, that's absolutely correct, and it was definitely a notable data point that caught attention. Domestic RevPAR decreased by 2.9% year-over-year in the second quarter of 2025. Now, management attributed this softening to, quote, macroeconomic uncertainty. It's a bit vague, and also some tough year-over-year comparisons. They mentioned the timing of Easter and a surge in travel related to the solar eclipse back in Q2 2024.
Okay, some one-off factors maybe.
Possibly. However, the company then took the more cautious step of lowering its full-year 2025 domestic RevPAR growth forecast. They initially expected somewhere between -1% and +1%, but they revised that down to a more conservative range of -3% to 0%.
Oof, okay. So potentially flat to negative for the year.
Potentially. And that revision, it signals a broader and perhaps more persistent slowdown than they initially anticipated, particularly among their core customer bases, the mid-scale and economy travelers, where discretionary spending appears to be softening the most.
So connecting those dots, what are the broader implications of this RevPAR decline for the everyday consumer, especially that middle-income traveler Choice traditionally serves? What does this tell us about their financial health?
Yeah, I think this RevPAR decline could very well be an early warning signal, a sign about the health of the U.S. middle-income consumer. It suggests that discretionary budgets are indeed tightening for a pretty significant segment of the population. Choice Hotels' vast network, so geographically diverse with all those mid-market brands, it almost acts as an excellent proxy for the travel spending habits of a large chunk of American households.
Good point. A bellwether, maybe.
Exactly. So, a deceleration in spending here, even while luxury travel surprisingly remains pretty robust, it strongly suggests that many households are feeling the pinch from inflation, from higher interest rates. They might still be traveling, like we discussed earlier, the desire is there, but they're likely doing so more cautiously, with a much keener eye on value, shorter trips, drive to destinations.
Which could actually favor Choice's bands in some ways.
It could. And it's not all negative for Choice, even in this environment. They are demonstrating competitive strength. For instance, their economy transient segment that's like individual business or leisure travelers in economy hotels, they remarkably outperform their direct competitors by a significant 440 basis points in Q1 2025.
Wow, 4.4% better.
Yeah, which indicates that Choice is actually gaining market share even as the overall segment might be contracting. It suggests maybe a flight to value, a flight to trusted, known brands during uncertain times.
Interesting. Okay, beyond just the economics, how are travelers themselves fundamentally changing their preferences, their habits, and how is Choice strategically adapting to meet those evolving expectations?
Yeah, the post-pandemic travel landscape is definitely being reshaped by several key behavioral shifts, and some seem pretty sticky. The pervasive rise of remote and hybrid work models, for example, that significantly fueled the leisure travel trend.
Leisure blending business and leisure.
Exactly. people seamlessly blending business trips with extended leisure stays, often resulting in longer trips overall. This is a direct structural tailwind for Choice Hotels' extensive and rapidly growing extended stay portfolio. It fits perfectly.
Makes sense.
Additionally, modern travelers are increasingly prioritizing unique, authentic experiences over maybe standardized, cookie-cutter accommodations. They want something memorable. Choice is directly addressing this shift with its Ascend Hotel collection, that soft brand we mentioned earlier.
Right, the independent hotels keeping their identity.
Exactly. It allows those distinctive properties to affiliate with the Choice system, get the benefits of distribution and loyalty, but keep your unique character and local charm. It taps into that desire for authenticity. And furthermore, continuous and substantial investment in technology is absolutely critical. Integrating things like AI for personalized travel planning, making the booking experience seamless. These are essential to meet evolving guest expectations and just stay competitive in a rapidly digitalizing industry.
No doubt. So, despite these notable headwinds, the franchise pressures, the consumer caution, the company is clearly not just sitting still. What are their big bets, their most significant strategic initiatives for future growth? Where are they really putting their resources and energy?
This is precisely where their proactive transformational strategy really comes into sharp focus. You can see where the investment is going. Perhaps their most strategically important and certainly fastest growing driver is their leadership in the extended stay segment. Choice isn't just a player here, they are a long-standing leader, and they are aggressively investing to widen that competitive advantage.
How aggressively?
Well, in 2023 alone, for example, they opened a record 61 new extended stay hotels. That's more than one a week.
Wow.
Yeah. And as of Q2 2025, their domestic extended stay portfolio had expanded by an impressive 10.5% year over year. And maybe more importantly, their development pipeline for the segment hotels planned or under construction stood at nearly 43,000 rooms. That signals really strong future growth.
43,000 rooms just in extended stay pipeline. That's massive.
It is. And this segment is particularly attractive because of its cycle-resilient demand characteristics.
Cycle resilient, meaning less sensitive to economic downturns.
Exactly. Extended stay hotels cater to a diverse and remarkably stable customer base. We mentioned construction crews, corporate project teams, traveling nurses, families relocating.
Yeah.
These travel needs are often less discretionary, less tied to vacations, and therefore less sensitive to economic dips than traditional leisure travel. And for the franchisees, the owners, these properties also inherently benefit from higher average occupancy rates, usually lower operating costs, less daily housekeeping, maybe leaner staffing models, and consequently, more predictable and stable revenue streams. It's an attractive proposition for developers, too.
They're really building a whole ecosystem here within extended stay, aren't they? Not just one brand, but multiple tiers.
They absolutely are, and that's a key strategic advantage. They've meticulously built a sophisticated, multi-tiered brand ecosystem, specifically within the extended stay category. You've got WoodSpring Suites and Suburban Studios anchoring the economy end of the market, catering to the most budget-conscious long-term travelers. Meanwhile, Mainstay Suites and the newer purpose-built Everhome Suites brand target the mid-scale customer, offering a more enhanced experience, more amenities.
So something for everyone needing a longer stay.
Pretty much. This diversified portfolio approach allows them to capture a much wider spectrum of demand. And critically, it lets them offer developers a range of products tailored to different market conditions and different investment costs. It creates a really formidable competitive position in extended stay that's quite difficult for rivals to replicate quickly.
Okay, and what about the ambitious move into the upscale segment? How's that progressing as part of the overall transformation? Is it really starting to bear fruit?
Yeah, that aggressive push into upscale is unquestionably a cornerstone of their broader transformation strategy. It's not just about extended stay. The 2022 Radisson Hotels Americas acquisition, as we discussed, was truly pivotal. It gave Choice immediate, significant scale and brand recognition in a segment where, frankly, they were pretty underrepresented before.
Right, they needed that boost.
They did. And this substantial inorganic growth, buying Radisson, is being strategically complemented by the continued organic expansion of their modern Cambria Hotels brand and that versatile Ascend Hotel Collection soft brand. This strategic push is critical because it fundamentally diversifies the company's revenue base. It moves them away from that historical heavy concentration in just economy and mid-scale.
Reducing reliance on one segment.
Exactly. It allows them to effectively compete for higher-rated corporate business, more discerning leisure travelers. And the numbers show progress. As of Q2 2025, their global upscale net rooms had grown an impressive 14.7% year-over-year. Plus, the successful integration of those Radisson brands, which notably exceeded the initial synergy targets of $80 million annually, that serves as a powerful proof point of management's strong M&A execution capabilities. They didn't just buy it, they integrated it well.
Good point. Okay, so beyond the US, what's the detailed plan for global growth? Is it basically mirroring their domestic strategy, push upscale, push extended stay, or are they taking a more tailored approach internationally?
International markets represent an immense, significant, and still largely untapped long-term growth opportunity for Choice. They are definitely underpenetrated in many key global markets compared to their larger peers like Marriott, Hilton, IHG.
Lots of runway left there.
A lot of runway. And they have demonstrably accelerated their international expansion efforts recently. We saw that robust 5.0% year-over-year growth in net international rooms in Q2 2025. Their strategy is pragmatic, though, and highly tailored to specific market dynamics. It's not one size fits all. In mature markets like Canada post-acquisition, they are strategically moving to that direct franchise model. More control, capture more value. Conversely, in developing markets, they wisely continue to leverage the local expertise of established partners through those master franchise agreements.
Like Brazil and China.
Exactly. That renewed 20-year deal in Brazil is huge. And that significant new agreement to develop potentially up to 10,000 rooms in China shows massive ambition. These efforts, combined with new partnerships recently forged in Europe, are significantly expanding the company's global runway for future growth and diversification. It's a key part of the long-term story.
And how is technology playing a role in all this? Is it just about enhancing the guest experience, or is it also a critical tool for the franchisees themselves? Is it just a cost center or a genuine competitive advantage?
That's a great question, because the role of technology has really evolved here. The franchisor's tech platform is no longer just a necessary operational cost. It is now absolutely a core component of the value proposition they offer to hotel owners. And Choice has made substantial strategic investments in this area.
Like the Choice EGE system.
Exactly. Launching Choice EGE, their proprietary cloud-based global reservation system back in 2018 was a massive undertaking, a huge investment. But the company's tech strategy has evolved even beyond that. It's moved from just providing functional tools to being a fundamental source of competitive advantage for the franchisees. The current focus is intensely on leveraging that Choice EGE platform and also the vast data set they get from their nearly 72 million Choice Privileges loyalty members.
72 million now, wow.
Yeah, it keeps growing. They're using all this data to create tangible, measurable value for franchisees. Management specifically talks about advanced revenue optimization services and tailored profitability tools.
Okay, what does that mean in practice?
It means using sophisticated data analytics and increasingly artificial intelligence to provide franchisees with superior pricing intelligence, like what rate should they charge tonight, optimized inventory management, how many rooms to allocate to which channel, and hyper-targeted marketing recommendations. This advanced capability genuinely enables their franchisees to outperform their local, non-affiliated competitors who don't have access to this kind of system-wide data and intelligence.
So it makes the franchise more valuable.
Absolutely. Crucially, it transforms the relationship from just a simple brand license into a sophisticated technology and data partnership. That significantly deepens the company's economic moat and dramatically increases the stickiness of the entire franchise system. It's a powerful differentiator that's much harder for competitors to replicate than just a brand name or a sign.
Okay, so Choice Hotels is consistently generating strong free cash flow from this highly efficient asset-light model. How do they, as a management team, decide how to use that money? What's their overarching capital allocation philosophy?
Yeah, their capital allocation strategy is notably balanced, I'd say, and highly disciplined. It's fundamentally guided by that strong, predictable, free cash flow generated by the core franchise business. Management has consistently articulated an approach that prioritizes, 1, investing judiciously in those strategic growth initiatives we've been talking about, upscale, extended stay, international, tech, and 2, simultaneously returning a significant amount of capital to shareholders. They have a long, well-established track record of being genuinely shareholder-friendly.
Can you give us some specifics on how they actually return that capital, beyond just saying they will? Are we talking consistent dividends, aggressive share buybacks, or a mix?
It's definitely a robust combination of both, which often appeals to different types of investors. On the dividend side, in the first 6 months of 2025, for example, they paid out $26.9 million in cash dividends. That shows a consistent income component for shareholders. For the full year 2024, total dividend payments were $55.5 million.
Okay, steady dividends.
Steady dividends. And then share repurchases are also a major strategic component of their capital return strategy. These have been a significant driver of earnings per share growth over time because they systematically reduce the number of outstanding shares.
Right, makes each remaining share worth more.
Exactly. In the first half of 2025, the company bought back $110 million of its own stock. And for the full year 2024, those repurchases were even more substantial, totaling $382.1 million.
That's a lot of buybacks.
It is, and I remember seeing an older investor presentation where they even highlighted the long-term nature of this commitment. They noted that over 99% of the company's cumulative free cash flow generated since way back in 1997 had been returned to shareholders through dividends and buybacks combined.
Wow, 99% since 97. That's incredible commitment.
It really is. It shows a very serious, long-term focus on shareholder value.
How healthy and flexible is their balance sheet, especially for supporting this ambitious growth strategy? Do they primarily use it just for those shareholder returns, or is it also a strategic tool to actively fund their expansion efforts?
They maintain a healthy and notably flexible balance sheet. It seems to provide them with the substantial capacity they need to fund those ongoing strategic objectives without putting themselves under undue strain. As of June 30, 2025, the company reported total available liquidity, that's cash, plus available credit, of $587.5 million. That's a decent cushion.
Yeah, over $500 million.
Right. And their leverage ratio, net debt to adjusted EBITDA, stood at a moderate 3.0x at the end of Q2 2025. Now, that level of leverage is generally considered quite manageable, pretty prudent for a stable, fee-based business like theirs with predictable cash flows. It doesn't appear to constrain their strategic or financial flexibility.
Okay, so manageable debt.
Manageable debt. And critically, in recent years, they've shown a clear willingness to use that balance sheet more strategically as an active tool to catalyze growth. That's maybe a bit of a shift from a more purely passive capital allocation approach from years past. For example, that roughly $112 million acquisition of the rest of Choice Hotels Canada that was funded directly with available cash and the existing credit facilities, it shows proactive use of the balance sheet for strategic M&A.
Right, using their financial strength.
Exactly. And historically, they've also judiciously deployed capital to provide that key money. We talked about those upfront financial incentives or loans, specifically to encourage and accelerate the development of their strategic new build brands like Cambria and Everhome Suites. Now, this targeted approach, while it does slightly increase the capital intensity of certain parts of the business model, it allows them to leverage their financial strength to speed up the achievement of those crucial long-term growth goals.
Who is actually at the helm guiding this major transformation? And how aligned are they really with the interests of long-term shareholders like you or me? What can you tell us about their management quality and their overall corporate governance?
Yeah, the strategic direction of Choice Hotels is firmly led by President and CEO Patrick Pacious. He's been in the role since 2017. And his tenure has been notably marked by a very clear, consistent, and well-communicated strategic vision. It's intensely focused on transforming the company's growth profile. Key initiatives under his leadership really include that decisive pivot toward the more profitable upscale and extended stay segments, the significant and ongoing investment in their tech platform, Choice EDG, and of course the landmark acquisition and remarkably smooth integration of the Radisson Hotels Americas portfolio.
So he's driven the key changes.
He has, and the senior leadership team supporting him is composed of seasoned executives, many with deep industry experience and long tenures at Choice Hotels itself. That provides crucial stability and expertise. A prominent success that really demonstrates their operational skill was that integration of Radisson Americas. It was completed ahead of schedule and, maybe more importantly, impressively exceeded its original synergy targets, delivering about $80 million in annual recurring savings. That's solid execution.
Definitely.
And while their unsolicited offer to acquire Wyndham Hotels and Resorts back in 2023-2024 was ultimately unsuccessful, the very attempt signaled an ambitious, maybe even aggressive approach to industry consolidation and achieving greater scale. They weren't afraid to make a big move.
Good point. What about governance? Board structure, independent?
Yeah, their corporate governance framework appears pretty robust, generally aligned with standard best practices for public companies. The board of directors includes a clear majority of independent directors, and its key committees, audit, human capital and compensation, corporate governance, and rominating, they're composed entirely of independent directors. That's important for oversight.
Standard good practice.
Right. And one particularly strong provision within their governance guidelines, is a director stock ownership requirement. Non-employee directors have to own company stock valued at 5 times their annual cash retainer within 5 years of joining the board.
Ah, so they have to have significant skin in the game.
Exactly. It's an important direct mechanism to align the financial interests of the directors directly with those of long-term shareholders.
That is telling, and something that definitely builds confidence. You mentioned insider ownership is significant overall, right? That further aligns management's interests with regular shareholders.
Yes, it absolutely is significant. Insiders collectively own a substantial 25.85% of the company's stock. That is an exceptionally strong signal, I think, of management's own conviction and confidence in the company's future prospects. They're betting on themselves.
A quarter of the company.
Yeah. And furthermore, executive compensation isn't just tied to short-term results. It's explicitly linked to key performance metrics like operating income and total shareholder return, which reinforces that long-term strategic thinking. For example, the value of compensation actually paid that's a specific regulatory disclosure to their income. Named executive officers in 2024 was about $21.2 million. Now, that represents roughly 7% of the company's 2024 net income.
Okay, how does that compare?
Well, it's comfortably below the generally accepted threshold of around 10%, which indicates, I'd say, strong alignment of incentives without excessive dilution of shareholder value through overly generous pay packages.
So it's not a situation where they're just printing shares to give management big bonuses. It sounds like they're actively reducing the share count overall for everyone's benefit.
No, quite the opposite, which is a very positive sign for long-term investors. They are actively reducing the share count through that robust share buyback program we discussed. In the year prior to September 2025, the number of shares outstanding actually decreased by a significant 4.77%. This systematic reduction benefits all shareholders by increasing their proportional ownership percentage of the company, boosting earnings per share over time, and ultimately enhancing shareholder value without requiring any additional investment from them. It's a good sign.
Okay, this all paints a very compelling picture: internally strong cash flow, shareholder-friendly policies, aligned management. But what does the broader market actually think right now? How is Choice Hotels valued compared to its own history and maybe more importantly, against its key competitors?
Yeah, the current valuation of Choice Hotels, it really reflects a complex interplay between that stable core business and its emerging growth vectors. And frankly, it shows a notable divergence, a bit of a puzzle. Historically, if you look back over the past decade, Choice Hotels' average price-to-earnings ratio, the PE ratio, measuring share price relative to earnings, was around 29.5x. Pretty healthy multiple.
Okay, almost 30 times earnings historically.
Right. But as of September 2025, the stock is trading at roughly 17.5x earnings. That represents a significant 41% discount to its own historical average.
Wow, 41% discount to its own past. Why?
Well, that substantial gap suggests the market is either pricing in substantially slower future growth than Choice has delivered in the past, or potentially that the stock might currently be undervalued relative to its long-term norms and future potential. That's the core debate.
Okay, that's a huge discount to its own history. How does it stack up when you compare it against its direct competitors, like Wyndham, and then against those bigger industry giants like Marriott and Hilton?
Right. When you benchmark it against its publicly traded peers, Choice Hotels' valuation, that PE ratio around 1720x, is broadly in line with or maybe slightly below Wyndham Hotels and Resorts. Wyndham is its closest competitor in the mid-scale and economy franchise space, and they typically trade around 1920x earnings, so similar to its closest peer.
Okay, comparable to Wyndham.
But, and this is the critical point, it trades at a substantial discount to the premium multiples commanded by the larger perceived higher growth players. Marriott, for instance, trades around 30x earnings, and Hilton is even higher, around 41, 42x.
Huge difference.
Massive difference. And the same pattern generally holds true if you look at other valuation metrics like enterprise value to EBITDA multiples, which account for debt. Choice trades much cheaper than Marriott and Hilton.
So what are we to make of this? Is the market essentially just not giving them full credit yet for this strategic transformation, for this big push into upscale and extended stay where they compete more with the big guys?
I think that's precisely the interpretation many analysts have. The market currently appears to value Choice Hotels primarily alongside its legacy mid-scale economy peer group, like Wyndham. It doesn't seem to be assigning a significant premium yet for its accelerated growth and strategic positioning in those more lucrative upscale and extended stay segments. even though these are the segments where it is increasingly competing directly with those higher multiple players like Marriott and Hilton.
So the market sees it as Wyndham Plus, not Mini Marriott yet.
That sums it up pretty well. The central question for the investment thesis, therefore, really hinges on a potential valuation re-rating. That would happen if or when management successfully shifts the company's earnings profile through that mix shift to more closely resemble those higher growth, higher multiple peers. The ongoing investment debate essentially asks that question. Will Choice Hotels truly become a mini Marriott, demonstrating consistent growth in higher value segments? Or will it largely remain perceived by the market as a Wyndham Plus, a slightly better version of its traditional competitor?
And the current valuation suggests the market is.
The current valuation, trading at that discount, suggests the market is largely adopting a cautious wait-and-see approach. They want more proof points, perhaps. Interestingly, analyst price targets currently average around $133 or $135 per share compared to the current price around $115. That suggests Wall Street analysts at least believe there's potential appreciation from here.
Okay, analysts see upside.
They do. But the valuation is highly sensitive. Key drivers will be net unit growth, those RevPR trends we discussed, continued expansion of the effective royalty rate, and maintaining margin discipline. And it's very sensitive to the overall health of the U.S. consumer and, critically, the accessibility and cost of franchise financing in this high interest rate environment.
Right, those franchise health concerns again. Okay, no investment, no matter how compelling the story sounds, is without risk. What are the main concerns, the significant risk factors that a potential investor in Choice Hotels should really be aware of?
Absolutely. While Choice's asset-light model has shown remarkable resilience, an investment here is definitely subject to several key risks. First, economic sensitivity and cyclicality. The lodging industry is inherently cyclical. It's highly correlated with the health of the broader economy, with levels of discretionary consumer spending. A significant economic downturn or a recession would almost certainly lead to reduced travel demand across the board. That would pressure occupancy rates, pressure average daily rates, and directly reduce Choice Hotels' primary royalty revenue stream.
And their focus makes them vulnerable.
Yeah, their historical concentration in mid-scale and economy makes them particularly vulnerable to economic stress affecting that middle-income consumer who might cut back on travel first.
Okay, cyclicality. What else? This raises an important question, maybe one listeners are thinking. If the individual franchisees are really hurting financially, does that directly impact Choice Hotels, even though they're asset light and don't own the properties?
Absolutely, yes. This is arguably the most critical indirect risk to the company, but the impact can feel very direct. Choice Hotels' entire growth model, its whole reason for being, is predicated on the financial health, the optimism, and the expansion appetite of its independent franchisees. They need healthy partners.
Right. They need owners willing and able to open new hotels.
Exactly. And the current environment, rising operating costs, labor, insurance, utilities, plus those elevated interest rates, it's putting significant sustained pressure on franchisee profitability and their ability to secure affordable financing for new projects or even renovations. Widespread financial distress among franchisees could have several negative consequences for Choice Hotels. It could lead to a slowdown in the new hotel development pipeline, owners deferring or canceling projects. It could mean delays in required property renovations, which hurts the brand image over time. And it could lead to a potentially significant increase in deflags hotels, terminating their franchise agreements and leaving the system entirely. That directly hits Choice's unit count and revenue base.
So franchise health is paramount, even indirectly. Got it. What other risks?
Well, there are intense competitive threats. As Choice strategically pushes further into that upscale segment, it faces more direct and formidable competition from the industry giants Marriott and Hilton. These established competitors possess superior global scale, much larger marketing budgets, far more powerful global loyalty programs with millions more members, and deeply ingrained brand equity, especially with high-end corporate and leisure travelers.
Harder to break in there.
Much harder. Defending its core mid-scale market while simultaneously fighting for market share and upscale requires absolutely flawless execution and substantial ongoing investment just to differentiate itself and build that upscale brand awareness. We also can't ignore the long-term structural threat from disruption from alternative lodging. Platforms like Airbnb, Vrbo, they still represent a persistent long-term competitive threat.
Still, even after all these years.
I think so. They've significantly increased the overall supply of available rooms in many markets, and they often compete directly on price and unique experiences factors very relevant to Choice Hotels' traditional customer base. Well, the initial disruptive shock from these platforms has maybe been largely absorbed by the traditional hotel industry. The ongoing competition for travelers' dollars remains a persistent risk factor, especially as consumer preferences continue to evolve towards unique stays.
Okay. And finally,
Finally, there's significant execution and integration risk. As we've laid out, the company is currently executing several major complex strategic initiatives simultaneously. You've got the continued integration of Radisson Americas, the aggressive expansion of multiple extended stay brands, and that multi-front international growth campaign.
juggling a lot of balls.
A lot of balls. Managing this level of strategic complexity across different segments and geographies carries inherent execution risk. Any significant missteps in integrating acquired brands smoothly, in successfully launching new hotel concepts, or in navigating the complexities of entering new international markets could result in a failure to achieve the desired financial returns on these very significant investments. That could definitely impact future growth prospects.
Okay, so after exploring all these different facets, the model, the strategy, the financials, the risks, for someone looking at this company through an investor's lens, what's the most positive story here? What's the compelling bull case for Choice Hotels?
The bull case for Choice Hotels, I think, hinges on several powerful merits that we've touched on. First, its core strengths, that remarkably resilient, high-margin, asset-light, franchise business model. It consistently generates stable cash flow and strong returns on capital and has proven incredibly effective through various economic cycles. That model itself insulates them from the direct capital and operational risks of owning property.
The foundation is solid.
Very solid. Then second, there's the clear, decisive strategic transformation towards those higher growth, higher margin, extended stay, and upscale segments. This holds immense potential to accelerate long-term earnings growth and structurally improve the company's overall profitability profile over time. Third, their disciplined and demonstrably shareholder-friendly capital allocation strategy, consistent dividends, significant share repurchases that consistently drives per-share earnings growth.
Returning value consistently.
Right. And finally, crucially, the current valuation appears attractive. It's trading at a discount relative to its own history and its larger, higher growth peers. That offers the potential for a significant valuation re-rating if this transformation strategy truly succeeds and the market recognizes it.
So stable core, growth potential, shareholder returns, and maybe an attractive price. That's the bull case.
In a nutshell, yes.
And on the flip side, what are the primary concerns? What might keep investors up at night? What's the core bear case for Choice Hotels?
The bear case primarily centers on those macroeconomic headwinds we discussed and the potential for further weakening of U.S. consumer health, particularly within their core, mid-scale, and economy segments. We saw evidence of that in the recent RevPR declines and the subsequent guidance revisions.
The consumer risk.
Exactly. Tied closely to that is the ongoing profitability squeeze on franchisees, stemming from slowing revenue growth, persistent cost inflation, high interest rates. That could severely stall net unit growth, which is one of their most critical growth levers. If franchisees aren't opening hotels, Choice doesn't grow its footprint.
The franchise health risk.
Right. And finally, the intensifying competition in the upscale segment, combined with the inherent execution risks of managing that complex, multi-pronged growth strategy. There's certainly no guarantee of success in these ambitious endeavors. Yeah, it's a compelling growth story, yes, but it's definitely not without significant challenges and potential pitfalls.
Okay, so for our learner listeners, the folks trying to understand different investment profiles, what kind of investor would find Choice Hotels most appealing? Given this intriguing blend of underlying stability and ambitious strategic transformation.
That's a good question. I think a profile is most attractive to what investment folks often call a growth at a reasonable price, GRB investor.
GRP, okay.
Yeah. It offers a clear, articulated strategic growth story rooted in that fundamental business model transformation we've dissected. But critically, it comes with a valuation that isn't excessively demanding right now relative to its history or its peer group. You're not paying a huge premium for that growth story yet. Plus, the resilient cash flow generation from its core business, coupled with the company's strong demonstrated commitment to shareholder returns, dividends, and buybacks, also appeals to those seeking a well-rounded blend. You get potential long-term capital appreciation and a modest but steadily growing income stream.
So not pure growth, not pure value, but a blend.
Exactly. It's a company with a strong foundation and a clear ambition for higher growth, but without those sky-high valuation multiples often associated with pure maybe more speculative growth plays.
Okay, if we're watching this story unfold over the next few quarters, maybe the next few years, what specific key performance indicators or potential catalysts should we keep a really close eye on to accurately gauge whether they're succeeding or stumbling?
Yeah, there are definitely some absolutely crucial KPIs to monitor. First, I'd watch the domestic effective royalty rate. Consistent growth in this rate, even if overall RevPR is flat or modestly declining, would be strong validation that their mix shift strategy towards higher value, higher royalty brands is actually working and boosting profitability per room.
Okay, the royalty rate itself.
Yes. Second, you want to meticulously track net unit growth, but pay close attention to the segmented growth rates. Are upscale and extended stay units growing much faster than the core economy mid-scale segments? That shows if the strategic transformation is actually translating into physical growth on the ground where it matters most.
Growth by segment, not just overall.
Precisely. Third, keep a sharp eye on international pipeline growth and conversion. How quickly are those international development agreements turning into actual open royalty-generating hotels? Is the pipeline converting effectively? And finally, a really important, though sometimes harder to find metric, is the franchisee retention rate. What percentage of franchisees are renewing their agreements? This is a fundamental health indicator of the overall franchise system and its stickiness. High retention is a very good sign.
Got it. KPIs covered. What about catalysts? Things that could really move the needle, positive or negative.
Right. Potential positive catalysts could include a clear reacceleration in domestic RevPR, showing the consumer is stronger than expected, or maybe faster than expected growth in their extended stay and upscale development pipelines exceeding targets, or perhaps a major new international partnership that meaningfully expands their global footprint and future earnings potential.
Things going better than expected.
Exactly. On the flip side, potential negative catalysts to watch for would be further RevPR deterioration, possibly leading to another guidance cut from management. Or maybe more public reports surfacing about widespread franchise financial distress. Or simply a sustained stall in net unit growth indicating the development engine is sputtering.
Things going worse than expected.
Yeah. These are the more immediate signals that will tell you whether their transformation is firmly on track, hitting its milestones, or maybe hitting some unexpected bumps in the road.
Okay, so let's try to synthesize this. How might this compelling and complex story play out in different macroeconomic environments? Can we sketch out a few distinct scenarios?
We can try. Let's start with a base case scenario. Imagine a situation where Choice continues its strategic execution, but the economy remains sluggish, maybe avoids a deep recession, but doesn't boom either. In this scenario, we'd likely see continued near-term pressure on domestic RevPAR, but this would probably be largely offset by continued net unit growth as their pipeline delivers and a steadily increasing effective royalty rate due to that successful mix shift. This scenario would likely lead to maybe mid-single-digit adjusted EBITDA growth annually, and the stock's valuation multiple would probably remain pretty stable, maybe stuck in its current range, reflecting a balanced risk-reward outlook.
Okay, base case. Muddling through, modest growth. What about the upside?
Right, the bull case scenario. Let's envision a situation where the strategic transformation really gains significant traction, maybe exceeding management's own expectations, and the broader macroeconomic environment improves more rapidly than anticipated. In this scenario, the upscale and extended stay brands achieve market-leading growth rates. International expansion accelerates and becomes a much more meaningful contributor to overall earnings. This powerful combination would likely drive a sustained period of high single-digit, maybe even low double-digit, adjusted EBITDA growth. And that kind of performance could compel the market to finally re-rate the stock's valuation multiple higher, pushing it closer to its larger, higher-growth peers like Marriott or Hilton. That's the re-rating thesis playing out.
Okay, bull case. Strategy fires on all cylinders, economy helps, stock re-rates, and the downside.
The bear case scenario. This would likely be triggered by a U.S. recession, a significant downturn that causes a substantial and prolonged decline in domestic RevPAR across the industry. In this challenging environment, the financial health of franchisees deteriorates markedly. This causes the development pipeline to shrink substantially as financing dries up and confidence wanes. Net unit growth stalls, or could even turn negative as deflags outpace openings.
Franchisees really struggle.
Exactly. And here, the company's ambitious growth strategy falters. The mix shift doesn't matter as much if the whole market is shrinking. and the stock's valuation multiple would likely contract further as long-term growth expectations are aggressively reset to a much lower level, reflecting increased risk and significantly reduced prospects.
Okay, three distinct possibilities depending on execution and the economy. This is truly where the strategic genius, maybe, and certainly the ongoing challenge of choice hotels really lies. It's a classic example, isn't it, of a company meticulously looking to evolve, to grow well beyond its traditional strength. They're leveraging that incredibly stable asset-light foundation to aggressively chase these new, potentially more lucrative opportunities, all while navigating a really tricky and unpredictable economic environment. And their ultimate goal, as we've clearly seen, is to fundamentally convince the market they are more than just a Wyndham Plus's company.
It really does raise an incredibly important question, I think, for all of us watching this space. As the lines continue to blur between traditional hotels and new, maybe more experience-driven travel options, and with the consumer increasingly splitting their spending between distinct luxury experiences on one end and undeniable value on the other, can choice hotels truly bridge that gap? Can they successfully achieve that valuation re-rating they seem to be aiming for? It's a strategic tightrope walk of immense proportions, really. And you'll certainly want to keep a close watch on those key metrics we discussed, the royalty rate, the segment growth, franchise health, to see which way they ultimately lean. It's a fascinating transformation to track.
Absolutely. What stands out to you, our valued listener, from our deep dive into choice hotels today? Did you realize they had such an extensive and diverse portfolio of brands, or that their entire business was so intensely focused on franchising and leveraging that asset light model? We sincerely hope this deep dive has given you a significant shortcut to being well informed about a truly fascinating and strategically agile player in the global travel industry. Until next time, keep digging, keep learning, and as always, keep questioning.